Good morning. Good morning if you're in America, in North or South America today. Good afternoon if you're in Europe, and good evening if you're in Asia. And I suppose if you're in Australia, it's a good night, or what are you doing up at this time? And welcome to episode 47 of the ESG Show. And today we are talking about ESG investing, in particular social investing. Now, this is not without controversy. And there are those who see the idea of social investing as a kind of woke investing. But I think we're going to find out today that it's not all lovey-dovey and nice, but it's actually got a profit motive as well. And it's actually good business. Well, bear with me, and hopefully we'll get the answers to that question. So, what is social investing? There are several approaches within social investing, including negative screening, which is avoiding companies or industries that engage in activities deemed harmful, such as tobacco, weapons, or fossil fuels. Then there's positive screening, which is investing in companies that demonstrate strong environmental, social, and governance practices like renewable energy, diversity, and sustainable business models. Then there's impact investing, directly funding companies or projects that aim to create measurable social or environmental benefits like affordable housing or clean energy initiatives. And then the shareholder activism, engaging with companies to influence their policies and practices on social issues, often by using voting power in shareholder meetings. Overall, social investing reflects a growing trend where individuals and institutions align their investments with their values, contributing to ethical, sustainable, and socially conscious business practices. But anyway, it's enough for me. Let's meet the guests. And on the show today, we have Bonnie-Lyn de Bartok. Hello, Bonnie, and it is good morning where you are today, isn't it, I believe?
Yes, it's 9 a.m. in Toronto here.
9 a.m. in Toronto. So Bonnie-Lyn is a recognised expert in social risk performance and impact measurement and management. Over the past 25 years, she has advised governments, investors, corporations, and NGOs across 60 countries. Her work has earned her numerous entrepreneurial and technology accolades, particularly for the development of the S-Factor quantitative methodology, social risk ratings, and social risk index series. She's currently launching or focused in launching a social risk hedge fund, which we will be hearing more about shortly. So Bonnie, I wanted to briefly talk to you about all your background. That's a lot of stuff that you've done in this sort of sphere. Can you just sort of expand on that a little bit?
Sure. So by way of background, I worked for the NGOs, and then I worked for the mining and oil and gas sector, and then I worked for the big banks. And in every capacity, I was building social management systems, training on executing, auditing, reporting on social management systems in each capacity. And then on the banking side, I was looking at projects from the outside looking in and quantifying risk. And so bankers investing in certain jurisdictions or industries would say, I know this is kind of a high risk, either industry or scenario, either industry or jurisdiction. And they would say, is this $1 million problem or a $30 million problem? How do I price this into my risk? What is it? And I realized then that the data that we required to model that probability did not exist. And so from there, I ended up building a data company, which now covers the entire public equities market. And we have about a 10-year history there. So from there, we've created the world's largest language model in social risk for public equities. We've built ratings, we've built indexes, and now we are in the process of preparing our inaugural social risk hedge fund in partnership with an investment manager. That's the background.
Okay, thank you for that, Bonnie. Now, I want to cut straight to the chase. Investing is all about returns. It's about profit. Yeah, sure, investors want to do good while they're at it, but that the focus is about making money, really. Why should investors care about social investing?
Yeah, so you outlined a number of social investing strategies like negative screening, positive screening, but social risk can be applied to any of them. So it's not necessarily either or, but a combination of different strategies. So in the public equity investments space, it refers to negative impact on an investment's value due to social factors. So disruption or lost time cost association in quant speak. The risks can arise from a number of social issues, labor practices, community relations, human rights, other factors that influence a company's reputation and operational stability. So you can correlate those behaviors, disruption, inefficiencies or production or outputs of the company. There is a system to actually monitor both of those. And so when we're hedging social risk, we're taking steps to mitigate potential negative impact of social factors. So public opinion, regulatory changes, social movements, the value of investments, and so on. And I know we're going to get into the composition of how we've constructed the fund, I think, later in your questioning, so I don't want to take up too much space, but really the approach is, yes, social factors can affect the value of your investments. And so we're going to talk about how to capitalize on that, how to hedge that, and what some of the strategies and approaches might be.
Okay, now I think you might have already, I think you might have sort of answered this question already, but I was going to say, why is it so important?
I mean, it's twofold. Number one, your investments, the companies are bleeding opportunity, right? So we are costing investors and companies money when we don't manage these things efficiently or effectively. But also you have the effect of harm, either on your employee population or the communities where you do business. And so the system is designed, our system is designed to reward best in class players. So mitigating that harm, retaining some of that capital that you are losing through mismanagement, and really just kind of hedging the book from some of that associated risk.
Okay, thank you for that. And could you just talk a little bit about the Social Performance Index?
Yeah, so so first we created the data set, and then we learned about patterns and associated with, I see some of the questions there, in harm. Yes, it's all about harm. The ratings are comprised, so the indexes are really a long-only best-in-class series based on our social risk ratings. And so best-in-class by social vertical, and social verticals would be specific to health and safety, specific to ethics, specific to supply chain, specific to labor. And then collectively, those make up the social factor best-in-class. But the ratings have about 1,200 social rules, and they are derived from now more than 47 frameworks. So these are codes, conventions, regulations, soft laws, hard laws, and they are blended into a norm. So if multiple frameworks are asking for the same thing, we only ask for it once. So we blended. We've been doing that since 2010. That's something we've been doing. And the proprietary scoring rhetoric, which measures performance against each one of those 1,200 indices, blends facets of impact measurement and management, but also social return on investment and lost time quant. So it's very sophisticated, but it's all automated in a systematic fashion now. And so that's what comprises the ratings. The ratings then inform the indexes.
Okay, now you're launching a social risk hedge fund.
Yes.
Now I don't know. When I think of hedge funds, I think of Darth Vader. I think of it's a hedge fund. Perhaps you could just explain to us what this involves and assure us that you're not Darth Vader. I know you're not Darth Vader, but
yeah. So listen, the fund is a quant arbitrage strategy. So there are different types of hedge funds, obviously. So some are known, the cowboys of the West are known for the high frequency shorts and disrupting the markets and taking advantage of all the mishaps and all of that. We're not doing that. This is not an activist fund. This is an opportunist fund. And it's meant to hedge the book from social risk, but also reward the best-in-class players. So quant arbitrage means that it is a long-short strategy. We're roughly around the 80-20 mix. Subject to change, obviously, as we ironed a few things out before launch, so we'll get more specific when we actually launch the fund. But roughly 80% of the long positions are initiated based on best-in-class S-factor indexed for social performance, complemented by fundamental performance analysis as well. And then roughly short 20% are triggered preemptive of significant outlier events identified through the S-factor rating rules, which entail notable decline in the proprietary rating system coupled with discretionary investigation of events. So what does that mean? It means that we can see early in the data, typically 1 to 3 months ahead of market, 6 to 9 months for some major events, that there's going to be a major disruption either to a sector, to a company, to a region, and we're preemptively changing our position based on that. And this is socially motivated events that are going to trigger that stock price change, and we're going to take advantage of that stock price change. Now, when I am pitching to the LPs, to investors, some of them get really squishy around the world social. They're uncomfortable with it. They don't like the association with ESG. They don't really play in the ESG space. Like it's too political. They're uncomfortable. So for those investors, I just explained at the end of the day, we've basically systematized signals, event-driven signals for disruption, right? So both positive and negative, where there's an opportunity to capitalize on those events. And again, the strategy rewards best in class. So it's not an activist fund. It's not a high frequency short fund. It really just demonstrates the value of those companies getting it right. It doesn't mean that companies don't have social issues. All of them do. What we are tracking is the ones who are managing it the best and who can recover the best from, external environment that may affect their business or industry. And so we know who those players are long before the disruption happens. And we're just kind of monitoring changes in regulation, changes in political events, political or social movements, reputational risk, even fake news can affect their industries. And how can they manage that? And are they doing it well? So beyond well-wordsmithed policies, do they actually have capacity and operating procedures ready to go, or are they scrambling when events happen to pull it back together? And do we believe that that company can recover, or if there's other companies better suited to recover in their same industry? So we're betting, arbitrage means that you're bidding both two different ways at the same time. So if there's an event that affects an industry or one bad player that affects the others, you can say, well, this is going to affect everybody. So if we have a major oil spill, for example, all oil prices go down. It affects the region, it affects the industry, affects them all, because everybody starts scrutinizing what else is at risk. And so we can say, well, these two players have the best practices in place and we think they're going to rebound, and we think these guys are just bad actors and they're not going to recover from this. And so we can predict that movement.
Okay, thank you. And thank you for your comment, Dawn. I'd like to bring Cecilia on at this point. And great to have the globe reasonably well catered for with the greetings that we've had this morning from a fellow Canadian, someone from the US, France, the UK, and Cecilia. I'm just going to have a chat with Cecilia for a moment, Bonnie. I'll talk to you again shortly. And where are you dialing in from today, Cecilia?
Today I'm dialing in from Brussels, where I am based. It's really great to be back on the show, and this is such an interesting topic to discuss. I will focus more, of course, on the regulatory elements, but I think that kind of, you can really see how it influences, and what Bonnie was saying as well about, the importance of this type of data and how investors can really use that.
Okay, well, thank you, Cecilia, and it's great to have you back on the show again. And I believe you're Swedish, aren't you, originally?
I am Swedish, yes, but I lived many years in London as well, so I'm one of those who lived in several places.
All right, well, that's good to know. Okay, so Cecilia is a senior advisor at Strife.
Yeah.
ESG Sustainable Finance Strategy Consultant. For 8 years, Cecilia served as a head of international relations for the Financial Reporting Council, which regulates auditors, accountants, actuaries, and sets the UK's corporate governance and stewardship codes. So, Cecilia, I want to talk to you about the importance of ESG within the regulatory framework. Can you just touch on that for a few, just briefly?
Yes. If we look at the European Union, they take this very seriously, and EU is really aiming for and currently are leading the world on the ESG regulatory framework. We see this, I mean, on GDPR and other legislation, this is a way for Europe to really take charge and also influence the rest of the global world on this space. So we've seen, I mean, in the last couple of years, we've seen quite a lot in this space, you know, on taxonomy. We have a sustainable finance regulation, and of course, the CSRD, which is of course about European sustainability reporting standards, as well as a new corporate sustainability due diligence directive, and that covers and sets out, you know, obligations for companies around environment and human rights. So all that, you know, taken together means that we have kind of a overall regulatory framework that for investors will of course generate much more data and information about companies. And just to say also that we have a new commission and the new commissioners, and we've just seen some of them setting out you know, the portfolios as well as von der Leyen giving them their responsibilities. And again, it's clear Europe still wants to lead on sustainable finance and ESG.
All right, okay, thanks for that. And in fact, we will be touching on one of the new commissioners shortly. CSDDD, Corporate Sustainability Due Diligence Directive, and CSRD. I don't remember what that stands for. Just remind me what CSRD stands for.
Corporate Sustainability Reporting Directive.
Reporting Directive. I should know. I've talked about them enough times. Can you? What have they got to do with investing?
Well, I mean, these are two very important frameworks that will give investors a lot of new data points, and also they can compare the information. If we look at the CSRD, so that directive set out clear indication about European sustainability reporting standards. And that means that European companies will have to report on these specific standards. And we have standards across E, S, and G. So on S, which we are focusing a bit here, there are a couple of standards around the workforce, workers in the value chain, affected communities, and users and end users. But, you know, this covers the, you know, governance as well as environmental factors, of course. And this means that companies will have to bring all these standards into their annual report. So instead of, you know, presenting a kind of a separate kind of ESG or sustainability report, this has to be integrated in the annual report. And as such, it will also be audited or assured. So again, it makes this an extremely important exercise for companies. And as an investor, you will, as of the reporting year, it's for 2024, but coming out in 2025, which is the first time we will see all European companies that are covered in the first round of the reporting, to actually give this type of data. And that will help investors to understand, you know, what companies are really doing, and also have the possibility to compare and contrast. So this is a fundamental change, and will also have an impact, I think, on other jurisdictions, because investors will kind of start to expect this type of data from companies globally.
Okay, I was going to ask you, how does this affect investors? But I think you've probably already answered that question, unless you've got anything to add at that point. I think you've covered that. Okay, well, thank you for that, Cecilia. I think what we'll do now is we'll have a look at some stories that have been in the press recently. And Bonnie, I know you spotted an article on responsible investor. US pushes back against human rights complaint over passive funds. Incidentally, I've put the links to all these stories in the comments section for today's show. But anyway, US pushes back against human rights complaint over passive funds. Can you tell us a little bit about what this is about?
Yes. So you're asking me. Sorry,
I am.
You are. You're asking me. Okay. So this is not new to UBS. This is not unique to UBS. This is a global open for debate scenario that people are watching closely, because as it plays out, it will affect investors everywhere. Europe is usually the lead on these events, but so I'll give you an example. I read up a little bit more on this. So they've faced multiple human rights. UBS specifically has faced multiple human rights complaints related to investments, particularly in its involvement with U.S. private prison operators such as CoreCivic and Geo Group. So the prison operators have been accused of serious human rights violations, including forcing detained migrants into unpaid labor and depriving them of basic necessities like food and water. But this article specifically, there are civil society groups in 2024 arguing that UBS has failed to conduct adequate human rights due diligence related to its investments within these companies. So they're pushing back, claiming that its involvement is passive rather than active. So their investments are made through index funds rather than directly. So they're not wanting to be accountable or responsible for the investments that they hold. They're saying that this is the responsibility of the index provider. However, what's really important to understand is that the Swiss National Contact Point, the NCP, has accepted the complaint. So it will be tried. I don't know if tried's the right word, but it will be investigated and evaluated, indicating that even passive investments may entail responsibility under the OECD guiding principles. So this is soft law, OECD guiding principles. If they're not signatories of the framework, it's a soft law that may actually impact the accountability of investors. So if it affects UBS in this case, we may now, yes, go 3. So how this plays out will determine how it's going to affect other banks in the same scenario. We've got some asset managers that dominate 80% of certain industries with zero accountability, claiming that they are generalists and not specialists, and they will never be that granular in their evaluations, and should they be? And that is the big question of the day. So that is what, this is now a global argument, and how this plays out will affect. So as we talk about the new EU commissioner coming into play, which I think we were going to visit, this is kind of related in that, he's an accountant by trade. We talk a lot about ESG controllers and the role of ESG controllers in systems and management and reporting. What does that tell us about how he will implement CSRD and CSR triple D? All of this is related. How this case plays out with UBS, how the new minister will enforce, like, the CSRD is now ratified as law. You are required to disclose and report, and there are enforcements of fines and jail time even. And so EU's pushing back. You noted some of this in the marketing for this event. They're pushing back that it's a cost burden, it's over-regulation, it's over-reporting for the sake of reporting. We've heard all of this before for decades, but these cases are now real and will determine the likelihood of a different outcome. So we're watching for that because we're watching which industries, companies, and investments portfolios will be affected by this. We can predict that depending on which way this goes.
Okay, thank you for that, Bonnie. Now, on the topic of that, I noticed Celia was going to talk about so Mario Draghi. He's been in the news. So he is the man who headed the European Central Bank at the time of the Euro crisis. And he famously said that he would do what it takes to save the euro. And later he served as a kind of technocrat prime minister of Italy. And he's written a report about EU competitiveness. I think he's called for a is it an 800 billion euros investment a year?
Yes.
Although I'm not quite sure where the money's going to come from. But so Cecilia, I'll hand over to you at this stage. Can you tell us a little bit more about this report?
Absolutely. Well, this is an important and very long report, and it basically has two parts. One is setting out kind of identifies the problems and the strategic issues. And the second part of the report is more kind of direct recommendations. And some of them go quite far. The vision is really there, but the question will be if member states are agreeing on the measures he proposed. So that's the kind of big question mark. But just to say that this is his vision on the future of European competitiveness. The big problem it identifies, of course, that the European economy is declining. We have a slow economic growth, and the surrounding kind of political environment, other countries identify specifically China, they're becoming more hostile, and there's enhanced competition. So he kind of goes into three priorities. I mean, the report is very long, hundreds of pages, but I'm trying to kind of summarize some of the key points. It's like Europe must refocus.
So you're not going to give us a summary of every page, then?
Exactly. I mean, if we have another couple of hours, I'm fine. But let's try to put it like three key points in the report, and some kind of measures that we expect to see from the Commission as well. I'll try to do it like that. So it's to close the innovation gap, specifically with the US and China in emerging technologies. Because he identifies, Europe has already lost this battle when it comes to existing technologies. So, we need to now be on the forefront with the new emerging technologies. And secondly, he kind of identifies, that Europe needs to blend the decarbonization objectives with retaining its competitiveness. And I also mentioned a bit here about, regulatory burden reductions and so on. We can talk about, there's another article about that, but it's really, how can we be competitive and still push the Green New Deal and the green agenda? That's super important. And also reduce our dependency on Chinese import, because that's a key issue. And the third issue he identified is, the EU should increase its security and reduce its external dependencies. And that is, they need to pursue access to critical raw materials, develop more digital services, and strengthen the defense industry. So kind of to outline, those are the kind of three priorities, and then we will have a lot of, measures and proposals to implement these in the next few years. And there is already a promise from this Commission that within 100 days, in this new mandate, they are going to develop a new so-called new clean industrial deal. As we said, this is also supposed to close this gap with, we have an investment gap, as you mentioned, 800 billion annually. And the idea is, this investment would come from both public and private sources. So, so that's kind of the overall objective of the report and his identification. I mean, the report is really, I would say it's a very good report, but again, he's really emphasizing the point that member states will need to give up some sovereignty. We have to work more as Europe, and as we know that those are super difficult measures for EU states to agree on.
Okay, thank you for that. So I suppose it's all about resilience of the supply chain as well, which seems to be the buzzword at the moment. Although I do sometimes worry that we focus so much on a resilience of the supply chain. I hope that this doesn't become just another way of saying protectionism. I think there's this narrow divide between a resilient supply chain and out protectionism, and I worry sometimes that we seem to be repeating some of the errors that we made in the 1930s when we went down the protectionist route. But anyway, but Cecilia, you spotted, so on the topic of Mr. Draghi and his report, you spotted this report, navigating Draghi's report on the EU's competitiveness, key sustainability issues. And there's a quote in there. The Draghi report raises raises concerns that the EU sustainability reporting and due diligence framework is a major source of regulatory burden magnified by a lack of guidance and a lack of clarity surrounding its interaction with other legislative acts, and that this entails a major compliance cost for companies in the EU. Could you, what are your thoughts about this? Is it a regulation too far? Are people getting suffocated by regulations, do you think?
I don't think we're getting suffocated by regulation, but there was fair criticism. I mean, if you exclude the kind of general criticism that always comes up in the ESG space about over-regulation, just looking at the framework, I think this is really what the critique is more about the existing framework, the emerging framework, and how that can be properly implemented. And there is a fair point there, because actually you have several different frameworks, you know, the sustainable finance regulation, taxonomy, CSRD reporting indicators, as well as due diligence obligations. So some of these frameworks, they don't really fit very well together. And you know, investors have said, you know, they're kind of internal, because investors are also subject to reporting requirements. And they need that to match with, let's say, the European sustainability standards and what they expect companies to do. And sometimes that doesn't really go well together. And I read the so-called letter from von der Leyen to the new commissioner for financial services, and it clearly sets out that, you know, she is supposed to push this forward and go through the sustainable finance framework and see, you know, how that could be better done. So I for sure in this mandate period, I think we will have new kind of, you know, a more coherent framework. So I think that is a fair criticism. I also want to point out that in the kind of development process on the sustainability standards, there was a clear, there is an obligation under the CSRD to develop sector-specific standards. And the regulatory body, the standard setting body called EFRAG, that they are kind of in charge of developing these standards. The Commission already, well, it was von der Leyen, but the Commission already said, oh, you have to wait. Please don't do this. It's just too much for companies. You know, first they have to understand how to report with the standards we just set out. So let's wait and see. So there was a pushback already then around this space, that it's just too much. Although the directive clearly says that this should be done. So it's already in law, but the kind of this type of implementation process will take more time and might not even happen if there is a pushback. Of course, this also has to do with European election, and we see the kind of EPP, those parties are doing better. We also see, you know, the commissioners within that family getting strong portfolios. So it comes to kind of the competitiveness of Europe and not overburden companies. And there is a commitment, of course, from the von der Leyen Commission in this term as well, to reduce regulatory burden with, I think it's around 25%. And at least I saw for the Commissioner for Financial Services, they set out a reduction of 35% when it comes to SMEs. And there's also talk about maybe changing the definition on SMEs, because mid-cap companies, they feel, you know, they are captured. And they have a lot of burdens. So, you know, maybe we instead of having a 500, you know, you go to like 600, 700, something like that. So we'll see about that. But there is a lot of things that will happen in this space. But that does not mean that they're going to kind of stop this development, because it actually, like I tried to say in the beginning, European regulation in this space is a way for Europe to be a powerful actor and influence the rest of the world. So they are not going to stop there, but the kind of the detailed, more painful exercise, and some of it that, you know, the incoherence between some frameworks that might change and should change.
Okay, thanks for that. Does anybody want to have a go at this question from Eric? How come China is said to be aligning on EU values, or at least specifically with green taxonomy, if the EU vision is bad for business? Anyone got any thoughts on that question?
Yeah,
you're convinced it's bad for business.
I don't think the EU vision is bad for business, but I do think it affects China's the supply chain coming from China. So as we've seen in the United States with SEC regulation on modern slavery acts, supply chains are being embargoed from movement if there is known forced labor practices involved. So, we'll iron out the kinks. I think that there needed to be a push to get something ratified because we've been talking about it for decades. And so, yes, I think they pushed the button before ironing out all of the kinks, and that's what we're seeing now. So it will come to fruition. The criterion is not new. So everybody thinks that we're compounding additional reporting, but the reality is, if you synthesize it a little bit, there is a norm across all of those reporting structures. So you will have to report one component to multiple entities, and that will, I believe, consolidate, like you see the consolidation with the global frameworks, IFRS, ISSB, and so on. We are coming to a consensus on criteria and criteria by market cap and industry, and even discounted factors for, external risk factors based on jurisdiction. Finding experts like myself in the space who can help you navigate that is really where investors need to go. And so you can tell very quickly whether companies, banks, portfolio managers are employing skill sets like this to navigate that, and whether or not they need to, or they feel they need to, or whether it's not their responsibility. And so that's, this is, the fact that all of this is on the table is really important and headed in the right direction. And so, but politics will play a role. So depending on how elections swing, both in Europe and America, they will eradicate some progress and they will push some progress. And as investors, you need to know how to play that. So even as investors, so if I give you an example, Trump's first week in office in 2020, he eradicated the Dodd-Frank Act. And that's very similar on responsible supply chains and human rights. But SEC came with their new rules on modern slavery acts and supply chains. So there are ways around it, even if governments don't want to do that. Some of the far right swinging states, in Europe as well, would likely participate in similar movements of pushing against some of the progress made on those regulations. And so as investors, we have to decide whether we are going to be responsible investors anyway, whether it's being enforced or not. Are we conscious investors? And if it's not regulated and enforced, do we care about this? And is it affecting our bottom line? And so really products like ours are going to try and push some of that agenda to say, yes, it is affecting you. Yes, it is affecting your bottom line. And yes, we can turn this into, a proper product.
Okay. Thanks for that. So you mentioned that there's an election in the US this year. I didn't know there's an election in the US. There's something happening in the United States this year.
Yeah.
Well, there you go. You just learned something on the ESG show. Who knew that? Yeah. Sorry. So the other day on LinkedIn, you mentioned. In response to the discussion about regulation going too far, firms like ours have decades-long proof of alpha related to the performance against said cost burden, reporting for the sake of reporting. How can we have decades-long performance when regulations are new and SMEs haven't even begun reporting yet? Because the criteria is not new. They belong to decades-old best practices frameworks ratified later to soft and hard laws, the evolution of which experts in the space have been following for decades. The differential bearing on performance versus compliance. Could you expand on that? Could you just explain what you meant there?
Yeah, I think I touched on that a few times already, but to your point, what we are asking, or what the EU regulation is asking for in terms of disclosure reporting, the criterion has been embedded in best practice frameworks for that have been around since the 60s on accountability and responsibility, and they've just kind of morphed and relabeled and repackaged themselves. So if you're deep in the rabbit hole focused on the evolution of these policies and ratifications, like I have been for decades and others like me, we're few and far between, but we are around, then you realize that this is nothing new. It's just being enforced now. And so there's pushback against the enforcement. So, you can kind of divide investment classes into, I'm not reporting on anything I'm not required to report on. It's I'm here to do business. And unless I'm required to report on this, I'm not going to waste my time. And so that's come about into ratification to enforce best practices around human rights. And supply chain and even labor violations, health and safety violations, like it's do no harm, kind of thematically, it's do no harm. And so we now need to build the business case around what's the benefit to you to actually get this right. We understand what the impact variable is on society, but do we understand what the impact is on our bottom line by mismanaging this? So if we can turn it into a business case, we move away from the stigma of overregulation and cost burdens. And so that's what, I'm on a mission to do. I have decades of business cases to prove that point. And so whilst the CSRD is new, what they're asking for is not new. And so we've actually been tracking those variables for decades already. That's what I meant by the comment was, I don't need to wait for companies to disclose and report. We have millions of sources of data and multiple, languages and voice to text and resources in our data center that we've been building for over a decade now, that can give us enough information to either model probabilities or effectively have material content that would suffice a score across the scoring rhetoric for materiality and disruption and position on the company. So I don't want to nerd out too bad.
All right, okay, thanks for that. Now, so can social investing, is there a correlation here with the share price? Can S affect the share price? Do you have any examples?
The answer is yes. We've seen so many examples of this. I mean, my favorite one to tell, if you go on our website to the analytics page, I think I have dozens of short cases there. And then, of course, within our indexes, we're able to position that. But, the Dakota Access Pipeline is a great example of what can go wrong. That was a pipeline running from Canada to the US or US to Canada. And they were going to run the pipeline through First Nation territory. And the environmental impact assessment was done by a government-led environmental engineering services firm in the United States. And the social component was left out of that assessment. And so the permits were issued and the project was moving forward. I think at best it was valued at $1 billion project. And they did not anticipate the volume of social disruption that would affect that project. So as the First Nation community revolted against that project running through traditional land and their water source, affecting their water source, it turned into a $9 billion problem. And there were 3 Canadian banks named as financing that project without subject to social diligence, who were left holding the cost of that. It was so significant that people closed their accounts and left the banks after being associated with having financed something like this. Like, it was pretty severe. And so that's an easy case to tell. So we've got hundreds of cases like that. And actually we're tracking that level of activity you can track by the hour, by the day, if you need to, if you're focused on it. And so that's essentially what we've systematized. All of that activity was predictable and foreseeable and preventable. And that is the case with most scenarios with social disruption. So you can predict if there's an issue in an industry, in a region, how it will affect most players and who's best prepared to manage it.
Okay, thank you for that. And thank you for the comment, Dawn. Dawn, I was just going to say, great leaders understand that proactively adapting to best practices generates great value. Thank you for that. Cecilia, I know you've got some comments on that as well.
Yeah, I just wanted to say that's exactly, I think these type of examples are so important, because regulation in this space is not just a compliance burden, and you might not even have to report, but it could be a competitive advantage for you to actually disclose data if you have good practices. So you have to view it from a broader perspective, and I think that's sometimes very lost in the political debate around this.
Okay, thank you for that. I hope we can just touch on this one quite briefly, because we've talked about regulation rather a lot. But how will regulation in the EU affect social investing, do you think? Do either of you want to have a go at that, or both of you want to have a go at that?
Europe's always ahead of us. It's very frustrating to sit in Canada because Europe does it first, and then eventually the States. We have typically Canadians wait to see what the US does, and we follow suit a couple of years later. But the US is always several years behind Europe. So I work globally, and so I can see the movement on all parts. So whilst EU is leading the charge, and I think there were some comments from participants there about Asia. Asia is paying close attention, and they are moving in tandem with the EU in preparation not to lose their competitiveness in the global marketplace, and to do what is required to get their supply chain out. But what's interesting in Europe is I saw, and I think you may have seen this as well, that European unions even got Tesla recruiting for ESG reporting for the first time in history. This is, in my world, we're passing around the job description saying, anybody want to take this on? Does anybody have the guts to do this? Does anybody want to go into this space? Tesla's been notorious for anti-ESG movement and, not wanting to commit to any frameworks and refuses to disclose and so on. And now they have no choice. And so some of us that have held ESG beliefs steadfast throughout all of the controversy and popularity sways and so on knew that this would come. So yeah, I mean that's
so watch Twitter for Elon Musk's approval of ESG then, I guess.
Yeah.
You say that the EU is always ahead of Canada, but in the field of GDPR, which I think there are parallels with what we're talking about today, the core concept of GDPR, privacy by design, which I think applies to ESG as well. I see a day when we have ESG by design, which is embedded into a business, was actually a Canadian invention. Dr. Anne Kavukian, who is the privacy officer at Ontario, I believe. So sometimes Canada sets the pace, I think.
We're good for research and development. We are notorious for that.
So Cecilia, do you have anything to add to that?
Exactly.
Okay. Anyone want to reply to Dawn's question here? Can you talk briefly, like the word briefly, about the attack on companies that voluntarily report and social hushing, like green hushing?
I'm not sure what that is referring to specifically. I'm not familiar with social hushing. I don't know what that is.
No, I'm not familiar. Well, maybe Dawn, if you want to elaborate some more, perhaps we can comment a bit more on that. What's the value of social data then? And what is social data, and what's it worth?
I think it's important to clarify. I can hear my dog drinking from his water bowl very loudly in the background here, but there's different types of social data, and there's sentiment data which tracks reputationally what the public sentiment is on a company or a topic. That's kind of high frequency topic tags, if you will. So if there are large volumes of complaints around human rights, it may be misinformation, it may be robotics feeding topic tags into large population social feeds, it may be. So But social risk data specifically is in a material event. So something that can be traced with a paper audit trail that is so substantial it can be held in a court of law as evidence. It needs to be that substantial to affect a position or a trade. So the value of social data is significant. If you look at the history of M&A in the ESG data space, I mean, there are very few companies that monopolize all the players that enter the space and earn any traction. I mean, the value on investments, I mean, we can prove that with the performance of our hedge fund. We've had a paper fund for 10 years. We've been live trading for the last 2 years on our social risk criteria in public equities. We're tracking an average of 23% annualized returns over that 10-year history, and it has continued in a 2-year live trading environment. Now, we haven't launched the fund, so obviously that will change a little bit when we get into transactional costs and so on. But we also haven't layered in any major sophistication on pricing and macros and stuff as well. So we're still ironing out the kinks, and those details will be confirmed when the fund is launched.
All right. Okay, thank you for that. So I just got 2 more questions for you. There's a lot of resistance to the idea of social investing. A lot of people don't like the concept. Why do you think that is? And is it misguided?
Yeah, I mean, the stigma around the word social, I get pushed back on all the time. We think of social investing as charity, philanthropy, foundations, impact investing for a better tomorrow. I think there's a lot of stigma there. I sat on a panel at the G20 summit in 2023 with the global head of UNDP, and the topic of the panel was how do we mobilize big capital to social issues the way we've done for environmental? And my position is that we have to build more of those business cases as to how it's hitting the bottom line, and turn it into a tangible risk hedge, basically, as opposed to how do we make tomorrow better. We need accountability for today. And so I think the CSRD is the step in the right direction to do that on disclosures, but it also will tell you how best the company's reporting and behaving. Performance matters versus compliance. So that is the big differentiator on the outcomes of the value of social. And that's the difference between well-wordsmithed policies and evidence of outcomes from monitoring and evaluating performance across that same criteria.
Okay, thanks for that. So Dawn's got back to her. She said social hushing, like green hushing, refers to the practice where organizations or individuals intentionally downplay or avoid talking about their efforts or actions in certain areas, typically to avoid scrutiny, criticism, or public backlash. While green hushing specifically relates to companies minimizing their communication about sustainability or environmental goals to avoid accusations of greenwashing or overstating their efforts, social hushing refers to a similar approach, but presumably in a social context. Any thoughts about that, either of you?
I think Cecilia.
Can you hear me, by the way?
I can hear you fine.
Can you hear me? Yeah, because I noticed that the screen has frozen. I don't know why, but yeah. So
well, the good news is
just to let you know.
We can hear you, Cecilia, and we can imagine your lips moving. Yeah, so any thoughts about what Dawn had to say?
I mean, my first instinct would say people who want to say less and be held accountable for less in order to be held accountable for less. So companies making public commitments can be held in a court of law, whether they are regulation or not. Collective bargaining can trump law in some cases as well. So the less they say, the less they're accountable to. If that's the direction. I mean, I'm not familiar with social hushing, but they minimize what they're saying. With greenwashing, what's happening is, we see this with the SEC regulations. They're saying, listen, we're not going to take a position on ESG, pro or for or against, and or regulate it or ratify it. But what we are going to do is actually validate that companies are doing what they say. And so a lot of funds and indexes that claimed ESG compliance were not. They were reliant on third-party data vendors, and they had no idea of the source of verification of criteria, and or the rules were too differentiated, or they didn't comply with certain, so that to me was a big impact wash, a green wash, a social wash. And so the SEC can say, well, actually, they're not living by the rules of ESG, so that doesn't count. So I would suspect people are saying less, firms are saying less in order to be not held accountable to everything that they say.
Okay. All right. And then Eric has got sorry, was that you, Cecilia? Eric's got a comment, not judging any culture, but is it possible globalization of values within the S of ESG factors is risky in some parts of the world?
Yeah.
Western culture, universal culture.
Yes. I have experience with this, working globally, obviously with the NGOs and in the mining industry. So some people believe that social data is the equivalent of DEI or diversity headcounts or female headcounts in representation. And in some cultures, you actually put women at risk for enforcing those quotas. So you can't really compare the participation of women in one country versus another. And maybe women just don't want to be there also. And so kind of enforcing the quotas. So I do very little in the DEI space. Yes, it's covered on the umbrella of social, but for me, social is much broader and really focuses on labor rights and harm and ethics and supply chain and so on. So definitely, it's hard to compare. For me, the criteria that we use is based on international best practice standards. And yes, it's very Western influenced, but the outcomes of performance. So labor rights, for example, the International Labor Organization has universalisms that can be applied in place-based outcomes. So you're measuring what the program is and what the outcome of the program is based on location and based on discounted factors for risk. So how I would measure labor participation in the United States would be very different from West Africa to Asia to Latin America. There are place-based specifics in their programming that need to be considered. And then how do you normalize that to compare an industry that operates in all 3 jurisdictions or 4 jurisdictions? So yes, there are factors to model probabilities and normalize the playing field in the outcomes of those behaviors. You're also, if we talk about labor practices and what is normalized in different cultures and regions, you can also integrate those values into the process. So this is where industry specific, regional specific, market cap specific benchmarks within industry become very important, as opposed to, we have a global best in class series, and that's where our fund is focused, but it does not exclude industry. It does not exclude any regions. It does not exclude any market caps. And there is no clustering amongst them for best in practice. But we do apply a lot of those rules on sector and social intricacies. So that's where the expertise comes in. That's really, it is niche, but it is sophisticated, but it's systematized now. Data and technology is an incredible thing. AI is an incredible thing. It can't run all by itself. It still needs human interpretation and intervention. And those outlier events really need to be investigated before the change of position.
All right, so unfortunately we've lost Bonnie. She's got problems with her. I haven't lost Bonnie. I'm looking at Bonnie. We've lost Cecilia. She's got problems with her internet connection, and I just WhatsApped her to say, okay, can you join on your smartphone? And it's only got one tick to it, so she's obviously got internet problems there. So I've just got one question for you then, Bonnie. Setting aside the morals of an investor or business, why is social investing good business?
Why is it good business? Obviously I'm mission and purpose driven, which is why I had to build the business case at large empirically to drive what we're doing. But I don't believe that firms should be able to profit at the peril of others. So morally, it should be law that you're not allowed to harm somebody to profit. And that's really what we're looking at on a global scale. That is what has become transparent. And whilst we think of some of these things as overregulation, actually, I think it is the competition. I think the competition should be flipped to say who can do the least harm and make the most money. I'm not an anti-capitalist, but I don't think that we should be exploiting people to get there. So that's really, I'm not activating against, I'm not an activist against people do that. Rather, I'm setting the best in class bar. So you know what, I can make 25% return also the right way with the least amount of harm. And so I just need to set by example how to do that. We can make money without having to harm. So.
Yeah, I mean, I agree. I mean, I'm not anti-driving, but I do believe there should be rules about driving. And I think it's the same about capitalism. I'm not anti-capitalism. I think it is the most powerful force that exists for creating wealth, but then there needs to be rules and some guidance, I think. Bonnie, thank you.
Sorry.
No,
I was going to say,
no.
I worked in some of the most invasive industries in the world, in some of the poorest jurisdictions of the world. And, I have seen mining companies do more for host communities than their own governments ever will in generations. So, from that perspective, not all mining are bad actors. I don't eliminate mining from my evaluation. I don't do that. The reality is that demand is 10 times its known supply. It's coming out. Who are the best players to get us there? Yeah, with the least amount
absolutely. Well, we can't exist without mining, can we? I mean,
yeah.
It's got to be there. Bonnie, thank you very, very much. I'm going to say goodbye on behalf of Cecilia, who's obviously got technical problems. But thank you very much. Thank you, everybody, for watching. Bonnie, I think we're seeing you again in November or possibly December. I'm not sure when, on Social Risk, I think the theme is. But thank you very much. And thank you, everybody. And see you all again soon.
Thank you. Thanks very much for having me. Appreciate it.